Good afternoon. Am I audible? Am I audible? Can you hear me?
Yes, ma'am.
So today others will be joining, but we'll be starting the class because we'll be taking the recording. So let us start, whoever is there. We'll go, some questions I've sent as by and by we proceed, we'll solve those questions. Today what we are going to do is, only Anmol is there. Yes, others are joining. But we'll start. Let them join. So let me today, first I'll be using the PPT as well as the dashboard. So I'll be switching over from here to the other. Mute your audio. Mute and can you see the PPT? Let me know. Good afternoon. So we are just starting. We have not started, but let us start. Okay. So let me know whether you are able to see my PPT or not.
Yes, ma'am, it is visible.
Okay, so I'll be showing you the PPT. After that, we'll go to the dashboard. Again, switch over. This way we'll proceed. Okay, to remove some of the question view. I've sent those questions which we are going to solve here. So first, what we are going to do today is valuation of bonds. So this is about valuation of bonds and stocks. So starting with, when we talk of assets, wherever you feel like asking any question, you will interrupt. Okay. So starting with, when we ever talk of assets, we know there are two type of asset. One is a real asset and the financial asset. Am I audible?
Yes, ma'am.
Okay. Tell once more yes or no, so that I see which side. Yes, just talk. Am I audible?
Yes, ma'am.
Okay. Avik, you just mute yourself. So assets, when you talk of assets,
Ma'am, you can mute him instead.
yes.
You can mute him, ma'am.
Uh, the problem is I have to go back and do that's right. So anyhow, see, when we talk of assets, it is real or financial assets. So financial assets, real asset, we all know your building, houses, anything real estate. These are your real assets. When you talk financial assets, these are your shares, bonds, any financial securities you are investing are your financial assets. So moving on, many things are there. You can go through it and send the PPT today only. And what we are doing here is evaluation of the shares and bonds, like we have done with real assets. Last few classes we spent on time value of money, where different timings of the cash flow were there, and you learned how to calculate their present value, future value, because what you're doing is valuation. Okay, so we did that in context of your physical asset. The same principle is applicable for your financial assets, and this is what we are going to do here by applying those principles to the valuation of your financial assets. So moving on, remember your ordinary shares. When you talk of shares, your stocks and all, which we are going to value after we finish up bonds. So there is a risk factor. Okay, so it does not mean that bond don't have risk. The bond also have risk. Bonds, when they're issued by the government, it is known as bonds, and when private corporates they issue it in India, it is known as debentures. Otherwise, both are bonds. But a higher risk factor is associated with your ordinary share. Okay, that risk factor is little bit less in case of your debentures, which are very similar to bonds. Features are same as bonds, but bonds are very much default risk default is very less, in the sense that government are the issuing body, and because of this the default risk are very less, but very less, it's not zero. Okay, so some of the terms we'll be using very often is, one is your redemption value. Redemption value means the value that the bond holder or debenture holder will get on maturity. Okay, so whenever the maturity period of the bond is there, say 5 years, 10 years, whatever, usually it is done for long number of years. Then after that maturity period, whatever value you get, that is what is known as the redemption of the maturity value. So when we do it, redeem it at the end of its mature value, it can be done at par. That means whatever the face value, you get it redeemed at the par value, or it can be done at a premium more than the par value, or at a discount which is less than the par value. How that is done, I will just go on, proceed to know that, because we are going to relate it to the rate of interest fluctuations. Now, what is the market value and how it is different? So market value means whenever you are trading the bond, whatever the current value in the market, it is what is termed as the market value of that bond. Okay, so this may be different from your par value or redemption value, because when it is being traded today, okay, so this today's market value of that bond may be higher than the par value. If the rate of interest is very low in the market, in that case people will pay more to get your bonds, okay, purchase the bond from you. In that case the market value will be more than the par value. And similarly, the redemption value, the maturity value, whenever it is going to redeem, say after 5 years it is going to you're going to get mature, and you're selling the bond now. So that market value, when whatever you will get now, will be something different from the redemption value. So market value is simply what is the value of that bond or debentures at present in the market. Now, when we talk of valuation of bond, we have to know some of the features which will have a effect on its valuation. A very simple, but it is the very long-term debt instrument or security. Long-term, because usually the maturity value is more than 1 year, 5 year, 10 years. Usually it is taken for long-term. Not only that, yeah, it can be traded also. Okay, so whenever you feel like, okay, you don't want the bond, you want back your liquidity back, you can simply go and trade it in the market. Then bond is issued by the government. So the default rate is very low, I said, but it's not zero, of course, it's low. Then the government will, why it is low? Because government will honor its obligations. Government will usually not fail. Then the bond, when it is of the public sector companies in India, are generally secured. Secured bond are those which are backed by collaterals. So in case it is defaulted in under any circumstance, in that case, the collaterals will act as a safety security, where the bondholders can sell them and get the redemption value. Okay, the private sector, when they issue the bond, these are known as debentures in India. Otherwise, these are bonds only. Only the nomenclature is a bit different. So a company can issue either a secure or an unsecured debenture. So secure debenture, as I told you, is when it is backed by some collaterals. Okay, and unsecured is when it is not backed by any collaterals. So these act as a security too whenever there is default from the lender side. In that case, the lender can always get it liquidated by using the collaterals. Am I audible? Am I audible?
Yes, ma'am.
And am I
Yes,
going
ma'am.
fast? It's fine. Is the pace fine? Are you understanding, or am I
Okay,
going
ma'am.
fast? Is it all
Yeah, I
right?
understand.
Okay, okay. So anybody who find
Yes,
that
ma'am.
I'm going fast will interrupt, okay? So some example of a secure debenture, for example, say a factory of a office building is a typical example, okay, of a secure debenture. So whenever there is any default, if a company or something default, then the whole physical assets are there which are sold, and the money of the bondholders and other preference shareholders, they are liquidated, they are paid back. Okay, so if the borrower becomes insolvent, then they are not allowed to sell the property if it is a non-secure debenture. It is not backed by the collaterals. Okay. So moving on, the main features of a bond or debentures. First is you know these names. First is it is the face value, which is known as the par value. It is the value at which the bond is issued. Okay, so it is known as the par value. For example, usually it is done at the level of par value of 100, 1000, or a multiple of that. Then the interest rate is fixed and known to the bondholders. So this interest rate is what is we call the coupon rate. On the bond, the interest rate which are paid are known as the coupon rate. And these coupons, that is the interest you get on the bond, are detachable certificate in the sense that you can trade in the market. Whenever you like, you can go to the secondary market and sell it, and some other buyers will be there. And maturity period is the specified period for which the bond or the debenture is issued. So whenever the maturity period will end, and you will be getting back the bond. So who can issue these securities? So this can be done by any legal entity. For example, a corporation, any investment trust, like your mutual fund and all, your government, foreign government also. These are the issuing securities of, these are financial securities. Now, before we go for valuation of bond, we'll look into some common securities and their difference with bonds. Let us talk about the difference between your preferred stock and the common stock. You know, equities are of two types. One is common equity, another is the preferred equity. Okay. Preference share and your common equity share. So if we come to your preferred share, so it gives you the any other share, it gives you the equity ownership to the company. And it is a tradable instrument on the your stock exchanges, public exchanges. You know, your preference shareholders will be the first to have the right to dividend in case the company liquidates, terminates for some time. Then the first person to get the right to the dividends are the preference shareholders, not the equity shareholders, the ordinary shareholders. First, it is the preference shareholder who will get back their money. Okay, so but what are the
Ma'am,
cons
could
of this?
you share the difference between preference shareholder and equity shareholder?
This is the difference. No, this is what we am pointing out. If it is, see, these are all the different point we are discussing. First is, I'll go switch over to 2 points. You see, if it is preference shareholder, you have equity ownership of a company. If you are ordinary shareholder, it is also same. You have the same right. Both are tradable on the stock exchanges. But the differences starts from you see the black ones have written. You as a preference shareholder will have the right to dividend first. Okay, in case the company liquidates, it is you as the preference shareholder who will get the money back first. After that only the bondholders, and then the ordinary shareholder, they will get back their dividend or money, whatever the money they have given. This is the first difference. Second, the cons, you do not have as much capital appreciation. In case any capital appreciation is there in the share values, you don't have a right to that. You have only like bonds, you have a fixed amount which you will get on your preferred stock. But equity shareholders, they have whatever the capital appreciation will be there, they will get a larger share of that because they are the risk taker. They have taken all the risk. So you will be having the right only to the announced dividend. You have your fixed dividend on the preference stock, and you will be getting only that much. No capital appreciation. Then similarly, no voting right. You don't have, as a preference shareholder, you don't have a voting right. Well, they have. They take part in all the major decision of the company. They have the voting right. You as a preference shareholder don't have. Okay, so another difference is, as a preference shareholder, you have the option that you get it converted into equity shareholder. You can convert it to ordinary stock if the company gives you that right. Such a reversal is not possible in case of your ordinary stock. You cannot become a preference shareholder. If you are a ordinary equity shareholder, you cannot go back to as a preference shareholder. And the last one is receives better treatment during liquidation. I said whenever liquidation of the company is there, it is the preference shareholder will get it first. And after that only the ordinary shareholders, they will get it. Did you get that vital difference? Did you understand the differences?
Yes, ma'am.
Okay, so moving on. Now let us see how they are different and similar to the bonds. I said we are doing the valuation of bond. So I'm just drawing a line between three of these major thing. One is your preference stock, common stock, and your bonds. Now, if you talk about bonds, so you see often they are issued at the par value. Okay, so your dividend may go above par, less, and at par also it may vary. And whenever the liquidation of the company is there, it is the bondholders will have a right to get it first. So now you contrast the features you saw about your preference share with the bondholders. So they are issued at par, independent of the market value. Interest rate is fixed, which will not change throughout the life of the bond. Whatever the interest rate is, coupon rate is announced, that will remain fixed. Okay. And bondholders, they have preferential treatment over the preference shareholders, ordinary shareholders, with in case of a liquidation of the company. And they have a fixed maturity period. Okay, so this is unlike your ordinary shares, but like your preference share. Okay, so coming on some common features which you saw, that they both get preferential treatment on liquidation, okay, of the company, both bondholders and preference shareholders. And bondholders are get the treatment first, then the preference shareholder they get. And the most important thing is, if there is any capital appreciation, both of them don't get a return on that, because they are not have not taken part in the risk, whichever was there in the company. So it is the ordinary shareholder who took it, and that's why they don't have any share in the capital appreciation. So these are some of the type of bonds we see in the market. One is traditional bond, where you can draw the principal at any time. Whenever you like, you can draw up the principal. Callable bond is the issuer may call it back before maturity. If it is issued for 5 years, 10 years, so it is up to the issuer that he may call it before that. Putable bond, the investor may sell it in the market before the maturity period. This is what is known as a putable bond. Then your fixed rate bond, having a fixed rate interest. Floating rate bond, where you have the option to have the coupon rate change floating after a certain period of fixed moratorium period. The rate becomes floating, and that option is available. Mortgage bond, where it is backed by different assets and securities. Zero coupon bond, where you are not paid any interest rate on the bond. Only the difference between your face value and the maturity value will be the return on your bond. This is what is termed as the zero coupon bond. You don't have an announced interest rate, unlike the other bonds which have. Then serial bond, paying the loan amount in small installments. Okay, this is what is known as serial bond. That means the amount of the principal will be paid back, amortized from time to time. Okay, some other bonds like climate bonds, raising fund for climate related issue. War bonds is there when you are issuing bonds for some specific war related issues. Inflation linked bond to tackle inflation issues. Time to time, the government may issue different type of bonds to raise capital from the market. Okay. So I've given you some links. You can go through and see how you can, you have to register, of course, okay, and see how you can invest in the bond. I'll take one session on this, but later on, after we do the valuation. Now coming to the types of bond, they are usually categorized into three. One is bond with a fixed maturity period. Other is the pure discount bond. And then perpetual bond, which don't have any maturity period. Okay, so first is bond with maturity. Here, issued usually by the government, they have a fixed maturity period for 1 year, 5 year, 10 years, whatever. The terminal maturity period is known to the bondholders. This is what is known as the bond with maturity. So under this case, when the bond has a fixed maturity period, you have two type of share. Are you able to see the screen, or did it go?
No, ma'am.
Just wait. Now it is there, I think, no? You can see now. You can see it?
Yes, ma'am.
Okay, so let us move on this. So bonds are of three types. One is bond with maturity. Now, when it is bond with maturity, you know you have two type of cash flow there. One is you will suppose it is for 5 years. So you have a fixed dividend or interest which is announced on it, which remains fixed, maybe semi-annually, annually, whatever the bond has declared the interest period. And at the end, what you have is the bond par value. That means whatever the face value of the bond will be redeemed at the face value. So when you valuation of the bond means you how much should you invest in such a bond? How much should be your maximum valuation or investment in such a bond? This is what we are going to do. Okay. So see, in this case, when you have a bond with maturity, your bond value at present, you see B0, subscript 0 means your value of the bond in the 0th year. So it will be the summation of your interest rate over the years. And then at the end, you get the bond par value discounted at the for that year. Now, can you tell me for the interest rate, which formula have I used? I've written the formula also. Still, I'm asking you that which formula is this? Have you gone through all the time value of money formulas I've taught till now? Yes or no?
Ma'am, could you repeat?
Can you see the formula on the screen?
Yes, ma'am.
Okay, I've written when we are doing the valuation of bond with maturity, you have two type of cash flow from that bond. One is you will get a yearly rate of interest. Every interest period, if it is semi-annually, yearly, quarterly, whatever the interest period, you are going to get a particular dividend or interest. That is one return from that bond. Other is the bond par value. That means at the end of the maturity period, you are going to get the bond redeemed at the face value. So I've written two formulas. Can you see here? Do you recognize the formula? We have done it under the time value of money. I said we are doing all the formulas. We have done almost 12, 14 formulas, I think. I said I'll be using it when we do the valuation of the stocks and bonds. So this is what I have used. Devasmita, are you there? Are you there? Acha, Arpan is there. Arpan?
Hello?
Arpan, which number formula is this? I've used with the interest rate.
Actually, I don't recall now, ma'am. I just joined.
Okay, all of you see, we did those formulas only because we are going to use it here. Don't worry, I'm going to do everything here, but still get acquainted with those formulas. That's why I did it with all the derivations. Okay. So this is what we are going to solve. Every sum, I'm going to go to the dashboard also and solve so that you understand. One I'll do. Now see this question. I've sent you on the WhatsApp. Fine, got this question? You can open the WhatsApp and see. Open that question. And what I do is I will go to the dashboard to solve this. Again, we'll come back. So this will be closed. Can you see the white screen? Can you see the dashboard? I told you just to see. Is it visible?
Yes, ma'am. Sorry, ma'am, by mistake.
No issue. That's why I said told you just to see, not to draw. See here. So what we are doing, the valuation of the bond, see that question. We are going to solve the first question. I am doing very slowly so that you understand. See, the N is given as 5 years. You refer to that question. That's why I have sent the question beforehand. And the bond par value. Par value means its face value is given as 1000. Okay. And what is the per annum dividend announced? It is 7%. Okay. Then you see it is given you that the opportunity cost, that is the rate of return. The rate of return in the market. Okay. So the rate of return in the market, that means the market rate of interest, is given as 8%. Know the difference. This is the dividend and this is the market rate of interest, the opportunity cost. So if you see this, there are two cash flow. One is you are going to get the dividend. So it is 7% of 1000 is the dividend every year. That's the coupon rate. Okay, this is your coupon rate. And the value, that is 7% of 1000, which comes to what? 70. Okay, this is your interest rate, coupon value. This is what is known as the coupon value. And 7% is your coupon rate. This is known as coupon rate on the bond. Okay, so now you are going to calculate the P value of that, valuation of this bond. So what is there? This 70, you know, this is the annuity. Isn't it? This is the annuity value because it is going to be the same. What is your annuity? We had three variables. One was your P, present value, F, the future value, and we had your annuity, which is, yes.
Ma'am, nowhere is there 7.5% rate of bond. It is 8.5.
Given the 8.5.
Yes, ma'am. The rate of bond is
See
8.5.
question number one. Question number one, you see. Question number one. Let it be 10% also. Don't worry. Let me do with this. You do it. Even if, who said this? Saidas. Who
Yes,
told?
ma'am.
Yes,
Yes,
Saidas
yes, ma'am.
will derive the same answer with 8.5. Doesn't matter. You just know the process. Don't worry.
Okay.
See question number one. It must be 8%. Still, if it is 8.8, doesn't matter. I'm just showing you the
Yes, ma'am. I saw the other question.
Yes, yes. Even if it is 8.5, you can solve. No. In the exam, I'll give you 8.5 only. Don't worry. So see 70. 70 is an annuity value because why annuity? Because it is the same return you're getting every year. For how many years? 5 years. Okay. So for that, you are changing everything to P value. That means you are converting everything to 0th year. So remember your fifth formula. That's why I asked which formula was that. It was your fifth formula, which was your P given A, I for n number of years. Okay, then at the end of the last year, which is your fifth year, you get the par value, which is your 1000. And you get it at the last year, nth year. That's why, remember the second formula. Second value is for a single payment. The second formula was for a single payment. That means this 1000 multiplied with P given F, I for n years. This is your second formula. So I just write how to get this. So here somebody has done. So I'm writing below that. It is your 70. Remember the formula. I'm writing the formula so that you will solve it afterward. So your fifth formula was 1 plus I to the power n minus 1 divided by I, 1 plus I to the power n. Okay. Then plus 1000. This is your second formula. So second formula means you are discounting it at 1 plus I, your power n, your last year value is 5. Okay. So here also your n is 5 in this formula. What is the difference? Both you got p value only. Remember, but this is for a single payment. You are going to get it at the end of the 5th year. That's why we use the second formula. Discounted for 1 year, from 5th to the 0th year. But this is for a series of formula. That means series of payments, 70, 70, 70 for 5 years. So same P you converted, you're finding the valuation of the bond. How much maximum you should invest in such a scheme. Okay. So if you solve for this, remember what is the percentage? How much is the percentage? 8%. Okay. So this I is your 8% here. So this is your 70. I is the market rate of interest you need to discount, remember. Okay, 7% was the interest rate. So 7% of 1,000, you got 70. 8% is the market rate of interest. I told you opportunity cost. What it means that at 8%, so if you have a money of this 1,000, whatever the unit, crore, lakh, whatever, you can simply invest in the bank at 8% and get your return. But you are diverting to this bond. You should minimum have to get a minimum amount of 8%. That's why you're taking 8% as the rate of discount. That's the sense. Okay. So you are discounting it at 5 years. This is the formula. 0.08. This is 1.08. Do it once in the class. Okay, 5. Then this is your 1,000 discounted at 1.08. This is from directly from the 5th year. What you did for 70, each year 5 times, you have brought it to year 0 and plus your last year value. And you see what is your answer. I'm giving you the answer so that I cover maximum. You'll check it afterward. Okay. After the class, whenever you have time, you check it. So you get 960.51. What it implies. So the maximum value you will invest in this bond should be 960.51, not more than that. If this is asking you for an investment of say 1,500 or something, so don't pay it. So you should not invest anything more than this. If it is less than this, yes, it's a good investment. You can go for it. So anything 960 and below is good for this scheme, for this investment. Did you all understand?
Ma'am,
Yes.
since the rate of interest is 8%, but the bond is returning only 7%. So we are buying the bond of 1,000 rupees at this price so that we get the profit equivalent to 8%, right?
Yes. Not no. See, market is giving you 8%. Okay. And the bond is giving you 7%. This now you'll do it. That means the bond price should be less, isn't it? Here you
Yes.
understand, from this concept, you can understand what is the par value, what is the more than premium and discount. See, the market interest rate is 8%. Bond is giving you 7%. So what should be the price of the bond at present? Should be more than 1,000 or less than 1,000?
Less than 1,000.
Less than. And this is the price.
Okay.
960 you should pay because market is giving you more rate of interest. If the bond is giving you less, you should not invest more than 960 in this. Did you understand? If the bond price
Yes, ma'am.
percentage is 9%, you will see this value will come more. That means you can invest more because market interest rate is low. We are going into this, how your bond price will be related to the interest rate more in details. But here it is
Ma'am,
easy to,
then if the market rate is less than 7%, then the bond price will be more than 1,000.
yes, it will sell at a premium. Because
Okay.
bond in this case will be more attractive. It will sell at a premium. This is selling at a discount. Did you get?
Yes, ma'am, got it.
Yeah, good. So see the difference, and whenever the market rate of interest, this so easily you have understood what is selling at a discount and selling at a premium is. So if the market rate of interest is less than this, in that case, you will see that this value will be more than 1,000. That means the bond price has to be more. Otherwise, why should people invest? market rate of interest is higher. Okay, so this is the valuation of a bond which is with a fixed maturity. We can also calculate the yield. Suppose the 7% is not given, then how we can calculate the 7%? Okay, this is what is known as the yield to maturity. Here 7% was given. That is what is the yield of the bond. Suppose the 7% is not given, how we can calculate how much the bond is going to yield given the other values? This is what we are going to do next. Listen, this session will get log out, but you will again join back. Till it is there, we'll continue. So now what I'll do is go back to the PPT. Can you see the PPT? No, I think, no?
No, ma'am.
No, because dashboard is open. This is either or. If you open this, that will go. Anyhow, we have to switch over because still you cannot see the PPT. Can you see the PPT now? Can you see? Keep answering.
Ma'am, it is showing the whiteboard.
So in the whiteboard only. Anyhow, let us talk then. So bonds yield to maturity. So what is bonds yield to maturity? It is the measure of the bonds rate of return. Like here, 7% is given as the rate of return. So bonds yield to maturity is the measure of the bonds yield to return. This will consider what is the yield to return, both the interest and any capital gain or loss. Because if it is over a long period of time, you may gain capital, you may lose capital. So if you are considering all this gain and loss over this period of time with the fluctuating market rate of interest, then this is what is termed as the yield to maturity. So you can take it as the rate of discount, which will make the present value. Remember the IRR I taught. So to calculate what is the rate of return from the bond, you have to find the rate of discount, which will make the present value of a bond, okay, current market price, equal to whatever cash flow you're going to get from that bond, which is the summation of the interest rate and the principal. So this is what we are going to do now. If it is board, go to the question 2. See what is your question 2.